The man is an expert at it. He's got 3 kids at home. I have 1 kid at home, and anyone that has 3 I look up to is like someone who can walk on water. Like they have the green jacket or the gold jacket. They can take a couple fish and some loaves of bread and feed the thousands. I mean, what are the ages? Are they all under 5?
They're all under 4.
Good Lord, my friend.
2 at 3.5 and 1 at 17 months. So,
wow.
Yeah.
So you got an amazing better half too.
Yes. Who is right now at home. Well, actually, right now she's at work. So we've got a babysitter who made it in for today.
I bet that was an amazing feeling for both of you guys. Not that we don't love parenthood, but any parent can relate. I know you can, Smith.
Yeah, I just got tired when you said that.
I know.
Just saying it, I got tired. I'm like, I'm going to take a nap now.
Oh, man. We're going to have some fun today. Did you see the ADP numbers this morning?
I did not.
Better than expected, which is a great macro KPI that came out today. The economy seems to be red hot. In January, historically, an indicator of how the market is going to perform throughout the year. So we'll talk a lot about this stuff, guys. This is a great opportunity for you guys to get to know what I'll straight up call, I'm going to embarrass Scott a little bit, the best mortgage guy in the Commonwealth right here.
Well, thank you.
The best mortgage guy in the Commonwealth.
I would have
Ross?
went with the world. I'm just saying.
I mean, I had to make it realistic here.
I went with the world.
Would you take the Commonwealth? You would take that, I believe.
Sure.
Yeah, you would.
Hold it, Marine. Hold it.
This
Time
is the
out.
first time I've seen Scott Morris blush over here, Keith Smith.
You're a Marine. It's just the Commonwealth, huh?
Confidence is fine. Humility goes wrong.
There we go, Scott Morris. I can already tell he's going to be good on the show.
I think I just got slapped.
What are you saying, Smith?
I think I got
I think Scott can offer a lot on that question. What are you saying, Smith?
Oh, Scott knows where the skeletons are buried.
Oh, I think we all know where all our skeletons are buried, and that's what
for
friendship is about. All right, J-Dobbs, we can rock and roll when you're ready.
Quiet on the set.
Good Wednesday morning, guys. My name is Jerry Miller, and welcome to the Wednesday edition of Real Talk. You heard me correctly, the Wednesday edition of Real Talk. Today's show presented by Ross Mortgage and the sharply dressed, very handsome and intelligent Scott Morris.
Thank you.
It was Scott Morris. It wasn't going to be you, Keith. Keith Smith is also in the house. You knew it was going to be Scott Morris.
I'm going to put my jacket on.
Brand new.
Even sharper dress, Keith Smith.
You're the distinguished Keith Smith.
The distinguished gentleman.
The distinguished gentleman.
I'm just going to sit here and have fun, guys.
I think the 3 of us are going to have a blast right here. So we're on the 3 shot already. You guys are on screen. Scott Morris, Keith Smith, Jerry Miller, live on the I Love Seville Network. A lot we're going to cover, a lot we're going to have fun with. Keith, I think we start with an intro and a showcase of our star over here, Scott Morris. The show is yours, my friend.
Thank you. Good morning. My name is Scott Morris. I'm the branch manager of Ross Mortgage, father of 3. That's 2-year-old, 3.5-year-old twins, and a 17-month-old little boy. My wife has a business in Culpeper, Virginia, as an orthodontist, and just looking forward to an awesome 2022 and seeing everybody and being able to help as many people as possible. Introduce
the community to Ross Mortgage.
So Ross Mortgage is a retail mortgage lender. So we're not a brokerage. We're going to handle your process from beginning to end. We service not many of our portfolio, so most likely it's going to be something that's then sold out, just like most loans are by most mortgage companies.
Scott, Keith, you've got a lot of experience with Scott.
I do, and some of it we won't talk about. but so that was an interesting point. Explain. Take a deeper dive into the difference between a brokerage and what you just explained. What's the real difference between that?
So a broker may have access to some more product, but they're also going to be dealing with an outlier of individual underwriters and or guidelines through these other companies that not everyone who does it is always familiar with. So they may be seeking a solution and get trapped in not being able to close your loan, or at least not close it in a timely and enjoyable experience, depending on who it is they're working with. I work with the same group of underwriters. I've got an in-house processor. Everybody, for the most part, I see face-to-face in one way or another. And I know these individuals. So if I've got a problem that needs to be talked through, I'm not dealing with just some roulette wheel of human beings trying to get this done for you.
So we talk about this all the time, trusted advisors, and I thank you for doing that. It's what I wanted to get out, because why it's so important and why we love using you and Ross Mortgage, Scott, is because I know it gets done, right? I know that you have resources to get it done. You don't hear the conversation, well, I've got to talk to 5 different people.
The man moves mountains.
He moves mountains. So, it's important in our business, in the real estate business, and in everybody's business here, is to get it under contract and get it to close. And I think I had a conversation with you on Christmas Eve, if I'm not mistaken, about helping us through an issue.
The man calls you on Christmas Eve, Scott Morris.
He did.
I texted first.
Texted first before a family friend or family member in solving a problem that just needed a little bit of clarity.
A lot of clarity. So thank you for doing that. So that's what you get, right? We talk about trusted advisors, and these iPhones we hold in our hands, and these laptops, and whatever this stuff we're doing is not going to get you to the finish line. It's these trusted advisors that will, because they all kind of blow up at some point. They all hit these speed bumps somewhere along the line, and you want somebody to pick up the phone on Christmas Eve and help solve a problem. So personally, I want to say thank you for doing that, because you helped out a family member. It was a huge ask. Out of state, by the way, wasn't even his client.
Who may be watching right now.
He may be watching right now.
Maybe watching the program right now. The power of social media. We love that family quite a bit. This is the $1 million question. And guys, if you want to give Scott Moore some props, you want to ask Scott Moore some questions, Keith Smith some questions, we're live across all social media channels. Put your comments in the feed, hit the like button, share the show. We have 2 experts of their field on set right now. Gentlemen, the $1 million question, and Scott, we'll start with you. Rates seem to be upticking right now. Tough question to ask. I think you get this probably every single day. Where are they going to go?
I mean, they're going to go up. How quickly they go up and how high they go up is the question. But you look at some of the forecasts. I mean, Wells Fargo and Goldman Sachs said that the U.S. 10-year would have breached 2% by now, and it's just barely, it's struggling to get above 1.5.
Yeah.
We might be at 1.6. I haven't looked at it today. But bottom line is the forecasts have been a little bit off about how quickly we would get there. But the one thing that's going to ring true is that the forecast into 2022 at this point is that the Fed is going to stop growing its portfolio. So that doesn't mean it's selling off what it has, but it's going to stop buying as many mortgage-backed securities or bonds in general on a month-per-month basis. And as that responsibility goes back to investors, they're going to hedge more risk with that. With more risk becomes higher interest rates for mortgages.
That right there is a good sizzle reel to mark down. That's a good second one right there. Gentlemen, how increased rates, Keith, Scott, will impact real estate here?
Well, we've been talking about this for quite some time, and I've got some stats I'm looking on my phone here. The last time it was, everybody's kind of predicting, I'll kind of reach out here, that by the end of this year, we should be approaching 4, right? That seems to be the
You think it's going to get that high? That's a hell of a jump, right?
So depending on, let's talk about like credit product and individual. I think some people, given certain situations, may be into the low 4s already. Somebody with, ideally, best credit, best scenario, still probably around 3.25.
Yeah, so Freddie Mac is predicting 3.3, Freddie Mae 3.5, MBA, which is the, help me out with the MBA, the mortgage-backed brokers association, thank you, at 4, they're the highest, and NAR's at 3.5. So I think you're going to see somewhere between a 3.5 and a 4%. But the last time that was that way was 2018.
Yeah, we're not that far away from where we were.
And the
we were
market,
selling
to
a lot
answer-
of houses at the time, so I don't see that being the problem.
Thank you.
Yeah, I mean, do we see that diminishing buyer pool, and by buyer pool, the number of buyers? And if the number of buyers are diminished a little bit, to use Keith Smith's analogy, it goes from the 16-foot Olympic deep end to what? Just the regular neighborhood deep end at 12 feet.
Yeah, you can still dive in it.
You can still dive in. That's what we're saying right there. Is that the illusion you're making right there, Smith? I
Did he
think you
just
said
say
it right.
Batman?
I think he's going to fit right in. Scott Morris is perfect right there.
Yeah.
I love this guy.
I'm just thinking about, we got Batman and Robin, what your costume is going to be next Halloween. I'm just
What would fit with the Batman and Robin and Alfred and Bat Dog? Because you're a good guy. You can't be the Penguin or Joker.
Oh, I see you as a Spider-Man.
Yeah, dude. I think you
I
could be
see
a great
you
Spider-Man.
totally
Okay.
as a
All
Spider-Man.
right, I mean, I can do that. I get to wear a mask. That's hopeful for what I'm
yeah.
Scott Morris, are you feeling positive? Okay, two-part question. Are you feeling positive of the real estate ecosystem from a macro sense across the country, and then micro sense here in Central Virginia in your neck of the woods, Culpeper?
Yeah, absolutely. I mean, we live in a very blessed area where Culpeper can be a bedroom community, even though it does have a pretty significant amount of manufacturing and some service work there for Fredericksburg and Northern Virginia and Charlottesville. And then Charlottesville's surrounded by well-developed bedroom communities, Fluvanna, Greene, Madison, Stanton, which also feeds Harrisonburg. We live in a blessed area. And then just across the United States, there's not, that we've got people who are qualified in making their mortgage, the ability to repay. That's one of the big things that we qualify for, and that's something that the stops have been put in to protect from being a fail point for the housing industry in general. So there's not a problem there. I see nothing but good things going forward. To your question earlier, how do interest rates affect things? So it makes somebody who may be qualified for $1 million property closer to 750 on their own comfort level. That's going to be a decision that people are going to make as individuals more so, I think, than the market's going to dictate.
Do we have a softer price point on the horizon?
No, I don't see it. It's again, I can quote some stats from all these folks, but at the end of the day, instead of double-digit increase year over year, we might be in the single digit, somewhere in the 5 to 7, depending on where you're at. Some areas will be a little higher, some areas will be a little lower.
About appreciation?
Appreciation, yeah. What the average sales price is going to go up in 2022 versus 2021. 2021 was an off the charts particular year. Two quick questions for you. How was your December year over year? So in other words, are you looking at more as the interest rate starts climbing up, more loan applications coming in? You mentioned earlier you're having so far a pretty good January.
Yeah, So purchases year over year, this December and January bigger than previous December and January. And what I'm starting to see more of is people who aren't scared of the difference in rate, but have had great appreciation in value in coming back and going after some cash out refinance activity to start making those improvements. Because we're really starting to see, in the beginning, people talked about it and you could sell it, but we're starting to get to the true benefit levels of refinancing, maybe with a slightly higher rate. If you were in an FHA product, you can go in and get out of the mortgage insurance that you were previously in. If we can get you to 80% loan to value, because those property values are starting to creep up enough to where that is a very real situation for everybody involved.
Oh man, you're throwing some knowledge out
Yeah,
here.
dude, knowledge bombs left and right here. What percentage of the business is refi versus home purchase?
Me personally, I'm like 80-20, 90-10, and I'd like to always keep it that way.
So 90-10 home purchase.
Purchase.
Yeah.
Now, there's months where that gets closer to 50-50, but all in all, I'm a purchase-focused individual. So if you are an agent out there and you want somebody who's going to be able to pick up the phone and respond to your clients and respond to you, I'm your guy.
I was asked the question yesterday, and thank you for being here. So this is a great show to do this on. Is there an interest rate difference between a purchase and a refi?
Great question.
depends on product, loan to value, debt to income,
Got it.
all
Credit?
of those things. Credit, all of those things make a
Which
difference.
is exactly the same as a purchase, right?
Yeah.
Yes.
Yeah, so I was told that there's two different interest rates. I said, you know what? I got a guy.
So if
You got a guy?
I got a guy.
You got a guy.
I got a guy. Let me have another sip of coffee. I got a guy.
If we're talking,
Sorry if the New Yorker came out. Apologize.
so it's very similar to as far as the LLPA. It's a loan level price adjustment. It's something that Fannie and Freddie are tagging all of us for. Just like if it were an investment purchase versus a primary residence purchase, you're going to see a difference in rate there, just as you would a rate and term refinance versus a cash out refinance. That's a very similar way to look at it.
So cash out. Let's talk about that for a second, because that's becoming a new thing now. Well, it's an old thing that's becoming new now, and are you starting to see a little bit of that? And talk about that process, how that works. So Yona and I want to refi our house for some cash out.
Is that a HELOC?
No, that is
Okay.
a mortgage that instead of rate and term, where you're just refinancing the primary principal. Let's say you want to take, let's say you did a HELOC, and now you want to pay that off. But you want, instead of having two payments or two different interest rates, affecting
consolidate.
the money, you consolidate it down into one. Let's say you've had some credit card bills that you've rung up over the last 2 years, and now you've got a significant amount of growth, and you've been in your home for say 7 years, and you can go in and cash out, so you can increase your loan amount, take that increased money, pay off those credit cards, and then you're paying what could be 13% rates on those cards into 3.75% on your cash out refinance.
And you come out ahead on the monthlies, and then
And-
you can conceivably catch up by throwing the monthly savings against principal.
And your cash flow gets significantly better.
And you have less stress.
Correct.
That's a hell of an explanation right now. Out of curiosity for me, one of my favorite things about doing these shows is I learn, you've said this many times, out of curiosity for me, which profit center is more advantageous for you, the home loan purchase or the refinance purchase?
What do you mean?
Which one makes more money?
The same. I get paid the
It's
same.
same?
Money. Yeah.
Interesting.
That's not different for me at all. And in most aspects, I prefer purchases. I mean, I love helping people.
You like making
fix
the
their
dream.
problems. But yeah, there's a significant amount of personal satisfaction and reward in helping somebody buy their first home, or helping a veteran who was told no because you can't do that with the VA loan. Well, it's like, well, maybe they didn't understand.
He's a
this.
veteran.
And so that's something that. But at the same time, if I'm helping somebody figure out like how to stop the bleeding with a debt situation, that is equally as rewarding in that sense.
We're in a very unique business, right? We really get to help people at the most basic terms. We help people stay in homes. We help people buy homes. And we help people have homes that could have two twins
Yeah.
and a little.
He's got
little
3
boy.
kids under 4, guys.
A little
4 and under.
under 4. And please don't invite me over to your house.
Superhero. And his wife. This is more Dr. Morris?
Dr.
Morris.
Dr. Eppard.
Dr. Eppard, you're killing it. You're a superhero too.
Married a doctor. Good for you, man.
No, dude. He outkicked his coverage, and he's killing it with his job. The dude is the golden
Good
boy
for-
over here.
good for you, man.
He didn't think when he was going to come on the show here that we were going to be his PR and touting him and stroking the ego, but we're doing it right now. And it's seriously sincere.
Well, he's got the 2 little people. I mean, you need some ego boost.
The three little people.
Three
The two little people are the ones that run the show, but the third
And
one's
they're
getting
both
there.
females.
Yeah.
Yeah.
How put in perspective the personality types of your 3 kids.
Oh, great question.
Is there an alpha?
Yes, absolutely.
One alpha?
Yeah, as of now, and she runs the show. The other is a little more kind.
Is that the girl or the boy?
Twins, the twins.
Okay.
The twins. One of the twins is the one who runs the show.
So you're saying one of them is a little mean, is what you're saying?
One of them
She's
is
not
mean.
watching right now, so you can say.
You want to bet?
We'll call her Bossy. We'll call her Bossy.
Bossy.
And then the baby, the boy, he's kind of he's like Charlie from It's Always Sunny. He's your wild card. He's your yeah.
Oh, that kid doesn't have a chance, man.
or he's gonna like cure cancer and solve the world's
yeah,
problems
no,
with
he's-
2 twin
yeah.
older sisters.
Yeah.
Or be a spaghetti sandwiches guy. You never know.
Yeah, spaghetti
I have two daughters, and I've learned the master of this. this. You just shake your head. That's what it is, because that's all you got to do is shake your head.
Jon Snow giving Scott Morris some props
Hey.
right now. If you want to give Scott some props or ask him some questions, please put them in the feed, and we will relay them live on air. This is a great question right now, and here's a sizzle reel waiting to happen. So you should mark this timestamp right here. This is from Christopher Friedman, who's watching in Louisa. What's the advice you give to a potential client that's nearing the finish line of purchasing a home that's looking for financing? This is a very good sizzle reel right here, Scott Morris.
There you go.
Reach out to myself or someone like me and identify any obstacles that might be in your way in time to cure them before you have to get under contract.
What paperwork? Give us the whole playbook, start to finish.
Start to finish. So what it would look like with me is if you called me and got to you right away as soon as we get out of the show, said, hey, let's get an application together. From the moment you completed application, we'd send you a list of requested documents, W-2s, pay stubs, bank statements, taxes, depending on if you're self-employed, and we would come up with a goal conversation and review and say, this is what your scenario looks like. This is how we could improve if we have a little bit of time. This is what, if you were to act right now at whatever price point you qualify for, that would look like.
So you have an app, right?
I do.
Right. So it is so simple to do it, because we've done it many times. You send the app to the client, they fill it out, you're able to process it pretty quickly. From a real estate perspective, I mean, that's what we wanted to do. We want to make that connection from the buyer to Scott and have Scott pre-qual them, because from our perspective, what we don't want to do is start showing homes that maybe the buyer can't afford.
If you were to reach out right now and you were organized in having the documentation that we were looking for, I would have you a pre-approval by this afternoon, and we'd have the conversation going over everything by the end of the day.
How many people that you do applications for actually can afford more house than they thought they could? Does that happen regularly?
Yeah, that regularly happens.
Yeah.
And part of the conversation when I talk about a goal review is finding a level of payment that you're comfortable in making a decision at versus just whatever big number you qualify for.
And that's important. So none of this conversation's been about how many beds, what's the house. This is all about relationships. This is all about Scott understanding the buyers or the client's needs,
Their profile,
and guide them through the process. Then we start having conversations about that. But I find quite regularly folks can afford more house than they think they can.
And they are convinced they need a greater amount of down payment than they actually do to qualify.
Oh, put that in perspective.
So the difference between down payment and closing cost, if you qualify, down payment is your total, is your initial equity in the home and can dictate your loan program or loan to value. Your closing costs are the costs that are paid that don't tie directly to the transaction. Your title, lender, and escrow fees that go into setting up your account. So your homeowner's insurance, your property tax, those types of things that can't be tied directly to the property. So if I could qualify you for 100% financing, you may need only 3% total cash to close to get the deal done.
And thank you for bringing that up. That is such a common
3% being whatever of the purchase price.
And that's a common misconception. It's ranging somewhere between 3 and 7%, right? And everybody thinks they have to have 20% down, then they do not. Now, having more money down could potentially put them in a different product. PMI is
Insurance,
a huge thing.
Which is one of the things I was talking about with, if you've been in the house for 5 to 7 years at this point, there's a very good chance that we can do a cash out refinance and remove that mortgage insurance from your expenses.
So PMI is private mortgage insurance, for those who don't understand, that don't know what that PMI
So
stands.
you don't have to refi to remove the PMI.
No.
You don't have to, but if you were, say, used an FHA product, Federal Housing Administration, to purchase the home, and you put down less than 10%, that mortgage insurance is for the life of the loan.
Yeah.
So if you were conventional, you wouldn't. You may need to notify your servicer that you believe that you've reached your 80% loan to value and have a conversation with them to get it removed. They may require you to get an appraisal to prove that.
Yeah.
But you wouldn't need the.
Oh, they may require appraisal to make sure the house hasn't gone down in value?
or to make sure that it's worth what you're saying that it's worth. If you're saying, hey, my house I purchased it at $370 and now it's worth $500,000, we're there, let's get this off. And they could go, okay, cool, you want to prove that to us? That's something that they might ask for.
My former neighbor, and this is important to emphasize, at my former neighborhood, went 3 additional years of PMI payments that he did not have to do.
Oh, yeah, sure.
Because he did not see the line item when making the payment and just continued making 36 months of payments of PMI.
Because they won't tell you.
They did not tell him.
Yeah. So that's why these amortization tables, when you get them from the closing that are like 40,000 million trillion pages long, you need to kind of keep a track on them. I'm at month so-and-so, it's paid down, so just 2 ways you can do it, right? You can pay your way down on it through your payments, or your home can appreciate. I'll make a little bit of a shameless plug for our side of the table here. We get phone calls all the time. Hey, can you do me a CMA on the property? Right? We'll do a CMA on the property sometimes. So they don't
CMA?
Comparative market analysis. I can do this. Comparative market analysis. Thank you. And that may save you the money of $800 or $400 or $600 for an appraisal, and it may work because when you send your request, you say, here's my CMA, and sometimes it may work.
You're getting props right now for a lot of people. Well, I identify some of the viewers, and if more questions are needed or want to be asked to Scott Morris, just put them in the feed. Kelvin Kraft giving you props. Sandra Dyer giving you props. Fabulous Jonas Smith, hello, and welcome to the show. You got some folks at your firm on the feed right now.
Thank you.
Yes Realty Partners, some agents at Nest, Real Estate 3, and Long and Foster watching Scott Morris now on the feed. Let's talk about the relationship you have with firms in the area that do business in real estate. You know a hell of a lot of people, Scott Morris.
I do. Nest, Long and Foster, Keller Williams, Remax, Century 21. It doesn't matter where you are. The bottom line is I am here to help you grow your business and your clients at a super high level. My team we're here to be responsive to your problems at all times. We build around a positive experience and being highly communicative. And what that means is there's no reason that you should be reaching out to somebody, and if you need the face of someone to speak to, that you're getting a team member to answer a problem that you need a direct answer for. What that means also is if you call me, I'm going to answer the phone or call you right back.
I can testify to that.
That's big time. What is it you like about Ross Mortgage?
So it's definitely a family feel, and they're headquartered in Michigan. It's like the mortgage capital of America.
Michigan is?
Yeah, Detroit. That's where Rocket and like all these companies are all headquartered. That's why they all have competing, like that. You see a ton of marketing in the sports world in that area for that. But this is a group that's been around for 70 years, and you've got a lot of the underwriters and employees that have been there for 20 plus years, and it's very relational. When I'm going and making phone calls and having a conversation with someone, these are people that, again, I know, see, and like, and can help solve a problem with, versus, back and forth in this email, hell, whatever you want to call it.
We can call it hell.
Yeah, hell. And a very not pleasant, like, impersonable situation. If it's solvable, we're going to get it done.
That's called institutional memory.
Amen, brother.
And that is so huge.
Sounds like something I don't have, but you can continue.
Nicholas Erpy, CFO of Emergent Financial Services, the CMO. Welcome to the program. You're getting props now from David Hayden and Michael Haynes. Welcome to the show. More questions coming in. We'll get to those in a matter of moments. The number one question, the top 2 or 3 questions you get in your business from potential customers? It's got to be rates, right?
Well, what are rates? How much money do I need, and how fast can we do this?
How about you, Keith? Very similar, right?
Similar. What are rates doing? Where are they going? Everybody's concerned about that. And I think you typically have the conversation. Well, if they move up a half a point, it really means this much, and it depends on how much cash you're bringing down and how quick you can get it done. But look, the market is picking up, right? The inventory is trying to grow
I
it?
saw listings go live with people putting signs in Monday with the snow. Like that means
Yeah.
somebody got out, they
Yep.
got to a house, and literally they were shooting a video, like putting signs in
Yep.
in 8 inches of snow with
Yeah,
no power
and
at
there
their
was-
own house.
And there was people ready to come right behind
Yeah,
that
yeah,
to go
yeah.
to go ahead and show it. But that's the same thing. I do want to tackle forbearance. Can we get into
Oh,
that?
absolutely.
Can we get
Absolutely.
into that?
Sabrina, hello.
So we've been having this conversation about forbearance, and there's some folks that are in forbearance. They're starting to come out, and we had a great conversation over. This was part of our Christmas conversation, and I learned something from you about the 3 months. You want to talk a little bit about that, please?
So let's say that you went into forbearance and now you'd like to refinance and come out. A lot of people have, or they started to, and then they found out that they needed to make 3 payments to be current in order to qualify by Fannie Freddie guidelines. So how do you make those 3 months without waiting 3 months to do that?
Thank you.
Well, you would make a mortgage payment on the 30th or 31st. Then you would make a mortgage payment on the 1st, and then you would make a mortgage payment on the 1st. So you would make mortgage payments in 3 months in 32 days.
So let's go through that for
So on the 30th.
an old sergeant, United States Marine Corps'
Okay.
brain. So let's take it nice and slow. Because this is important. Most people think I have to wait like a whole quarter to do this, but you can do this in 32 days. And the reason it's important to pay all 3 is why? Because it's a requirement, right?
Because if you don't do it, you don't qualify.
Got it.
That's the guideline.
So in order to refinance, you've got to show 3 months of payment outside of forbearance, and you can do that in 32 days instead of 3 months and refi. Because some of the conversations that I'm having with people about that, they're worried about waiting 3 months. What if it goes up a quarter point? What if it goes up a half a point?
Are you not going to? Well, then you shouldn't have gone into forbearance and then fight the timeline. But if you have to deal with the problem,
response.
does it matter that you have to wait 45 days before you can do that versus
No.
waiting 90 to get it done?
Yeah, that's
So-
a great
so-
response. Johnny Ornalis, hello. Keep going.
So this is a very clear reason why you need to hire Scott and
Definitely.
you need to do a trusted advisor, because I actually thought it was 3 consecutive months until this morning before we went live. And that so hopefully folks that are watching that are trying to come out of this and refi, they can architect this in such a way that they can get themselves out of forbearance in 32 days, excuse me. Pick up the phone and call you and refi. I think that's an important piece of information to get out.
Jamie Turner, Gordonsville. Love this edition of a show with Scott Morris. He's incredibly knowledgeable, and I will certainly do business with him in the future. Jamie Turner, we love when you watch the program, contribute, and offer perspective. Mustache Dan Pettit, Real Estate 3. We love you, Dan Pettit. We love your comments. Do you know Scott Morris? A lot of appraisers doing just drive-bys.
I haven't seen a lot of that since we were like really
In the heart of COVID?
Yeah,
Yeah.
like yes, that's what we'll call it.
Yeah, and the doldrums of the pandemic, and we'll leave it at that.
Yeah.
We'll leave it at that. Scott Morris can play the game. What are you seeing innovative techniques, if any at all, in the appraisal business? Are you seeing anything new there, or is it same old, same old?
Same old. Love appraisers. They just like anything else. They're overwhelmed. You get low hanging fruit. You get a more rural property, the more difficult or timely the process gets. As far as turn times, if it's in the city of Charlottesville, Culpeper, Fredericksburg, Manassas, Richmond, Roanoke, it's going to turn around super quick and shock everybody. If it's in Churchville, Virginia, or somewhere that is off the beaten path, Powhatan, Goochland, you're going to have longer turn times trying to get something like that done.
You'll love this comment, and then throw it to you.
Yeah, sure.
David Hayden.
Yeah.
Scott is the freaking man. I added the freaking.
Okay.
Scott is the man, is what he said. Semper Fi, Devil Dog. I'm
yeah.
doing business with Scott Morris right now.
Right now, we're getting them closed today, getting some complicated problems taken care of, and helping a super awesome human being.
Is one of them being a Marine? Is that part of being the complication?
Marines, we make it harder.
Oh,
ourselves. That's what
God,
we do.
God. We have to talk about crayon eating at some point so we can explain that to the general public, what that actually means. So let's stay on appraisals, right? So most folks, us in the business, we understand how this process now works. But most folks that are not in the business, explain that pool process, right? Exactly how the appraisal process works and how you're almost can't speak to the appraiser, right? Only the real estate agent or very few people actually can communicate with the appraiser. So, you just can't pull something out of a hat. You have to go through a process.
So, yeah, one of the rules put in place back in 2009
Probably for the best.
was to remove influence over value from the lender. Meaning I can't call my buddy who does this and say,
You know a guy.
Hey, I
know a
hey,
guy.
hey guys, this thing needs to come in at 500. I know a guy. And
Was that happening?
Oh, yeah.
Yeah, I mean,
Oh, yeah.
how does it not? Do you want me to send you more business? Make sure you get it done.
Yeah.
Right.
That's.
How it was done.
The system was very much so broken.
Yeah.
So now it's set up to remove that. So there's either depending on some individual banks may have their own pool and not go through an AMC, but then they've still got no one directly in the loan process can be the communicator with the individual. By the individual meaning the appraiser. So the appraiser signs up with an appraisal management company. That's the AMC. A lender makes a request to the AMC, and they put it out and they assign it to someone. Someone being the appraiser. An appraiser accepts the assignment, and then goes and appraises the property. Now, let's say that the property is in one of these more rural areas, and this is someone who's like, look, I can get 10 of these done inside of a more metropolitan area, and make more money than
If I got
driving
3
an
on one
hour
block.
one way to go get one of these things done. That's when the location dictates the time it's going to take to get their appraisal returned.
So it's like a bidding system, right? So basically you throw it out into this pool, and I'm an appraiser and Jerry's an appraiser, and he looks at that. He says, I'll take this one. I won't take this one.
Correct.
I'll take this
Yeah.
one. I won't take this one. Jerry will pick.
And they might assign a cost to it as well if they're saying, "Hey, I'll take this one in the middle of nowhere." But that's why.
Who bears that cost?
The borrower does. So that's why if I told you that your appraisal is going to be $625 and it comes back at $825, it's because it was in the middle of nowhere, and we found someone to accept it, and these were the terms. Maybe I found two that said that. I had somebody 2 weeks ago quote $4,000 on an appraisal, and I was like,
And it wasn't a commercial project?
why don't we just keep looking? And eventually we found somebody who did it for like
$4,000?
yeah. So I mean,
roundabout it's what, 5 to 750, right?
It was basically them saying,
Extortion.
I mean,
clearly, I'm not going to do this, but
You're going to pay 5x what it should be.
Exactly.
I mean, that's what you
It's
pay.
even
I
more.
paid
That's
that
like
on.
8x.
I paid that on commercial deals,
Yeah.
but man. So
Clearly, we did not use them.
Yeah, but again, this is about using somebody you can trust, and so if I'm the buyer and I'm coming in and I have something a little remote, you will have that conversation. Look, normally it's about 600, but this is how the process works. It may go more because we might have appraisal, so it's not a surprise.
Correct.
And it's
We're going to have that conversation. Like that's one of the questions in asking. So tell me, where are you looking to purchase at? So once we've identified something like that, it can give us an idea of how to set expectations through the process.
That's why this app or
Yeah.
app or whatever,
It's incredibly inferior.
it's inferior. It could give you
In person is where you want to go.
Absolutely.
Direct line to this dude. How about this question? Are you seeing a greater amount of townhome contracts versus detached homes due to prices of homes in our market today?
Great question.
I mean, we would if there were more
Inventory?
inventory available, probably. I mean, that's the biggest problem, So a detached property has a lower price point, but then there's more people qualified at that lower price point, so it's on and off market even faster.
How much does HOA and condo fees
Good question.
take into consideration when you're qualifying somebody?
My father-in-law, and now this is a different state, and this is on Long Island, an area you know well.
Long Island.
Long Island. Over $700 a month in HOA fees.
That's actually
In HOA or condo?
Actually, he's a townhome.
Okay.
That's
so
actually
it's
not that
probably
bad for up
it's
there.
probably a townhome
Substantial.
that's set up as a condo.
yeah.
That's a good question. I asked him what he gets from that, and there's a pool, there are pickleball courts, and interestingly for this place, Southampton, which you
Yeah,
know,
sure.
it's a place on 80 acres, and the acreage wasn't fully developed to maximum density.
Ooh.
So the limited rooftops they have there have significant flat land for them to enjoy. So he literally in his backyard, now he doesn't own the backyard, but in his backyard is like 4 flat football fields.
That
So
he
they're-
doesn't have to mow.
Exactly.
That he doesn't have to.
And that's why they're so high. So he's like, he has this backyard
Yeah.
where a lot of them don't.
Sure.
And there's not that much congestion.
Yeah.
You can be in Arlington, so I don't see super high condo fees in the Charlottesville market, but when you get in Northern Virginia, I can easily see $400 to $600 condo fees on a $300,000 condo.
We just
Really?
don't- Yeah.
Good Lord. So that is what, on a $300,000 condo, the monthly, depending on your down payment.
It's like a quarter of the payment.
Yeah, I would say your monthly on something like that is what, like 1,900?
Yeah.
1,800?
Then you throw in the high tax rates up there.
Yeah, that's pricing people out right there. What's the highest condo fees you're seeing in Central Virginia? Like by location?
Like 200, 250.
Yeah.
I think that's
And
what it
where's that? Do you know?
There's so few of them around here.
Yeah?
That's the struggle. We don't have a ton of condos in the Charlottesville area. I off the top of the head, there's just a couple of few, maybe half a dozen. Somebody does a little bit more.
Penthouses up here, know them well. You're looking at $5 a month.
Yeah, so that's residential on the top of this building.
Yeah, third
right.
floor is residential.
Yeah,
Villas at Southern Ridge, my rental is like $1.85.
Yeah.
And that was on a low end.
Yeah, the struggle with, and this is a great question to bring up, the struggle with the condos is finding warrantable and non-warrantable ones in this area, and quite a few of them are non-warrantable.
Explain that.
Do you want to take a stab on it, or would you like me?
You go ahead and explain that. I'll tiptoe a little bit on, because I don't do enough of them that I'm super, super familiar. But however, one of the ways that you get around the whole warrantable, non-warrantable is a conventional 10% down, get you into limited review, which solves a lot of those problems depending on the unit.
So-
but I'm going to make a request to the condo association
to.
right away, because that's going to answer a lot of our problems. However, that's another borrower cost, because most of these associations charge $300 just to issue the paper.
Or more. You're
Yeah,
talking
or-
about the
yeah,
condo.
yeah,
Yeah, so the basic difference is the percentage of ownership of investors versus owner occupied, and it's 51%. And once you start getting past that 51%, it becomes difficult to warrant. But what I heard out of this hearing aid on the right-hand side
That's
is,
the one that works.
Gotcha.
Is that the one that works?
well, yeah. Maybe I should shut it off.
What's the deal with the left one?
The left, yeah. Yesterday's show, my left hearing aid died on me, and those who wear them, they start talking to you when they're dying, and it's telling you, hey, our battery's going dead, and I'm having a conversation with him, but anyway.
And Judah was talking in the triangle of content, remember? I will say this, and I genuinely mean this, Keith. You do a hell of a job, regardless if you have the right glasses or the hearing aids.
Oh,
working
we're gonna talk
correctly.
about the
You are
glasses.
fantastic in this setting, my friend.
Yeah, I'm wearing my normal glasses and the reading glasses. I cannot see him at all.
How the hell did you drive
So
into
you've
the
got
studio?
selective hearing, and you hear voices,
And he can't see.
Okay,
And he
got it.
drove to work from Lake
Hey,
Monticello.
I'm doing good.
And he drove to the studio from Lake
Hey,
Monticello.
let me help you sell or buy a house. Oh boy.
I love Keith Smith so much. Did you finish the warrantable analysis?
I don't. Yeah, we went off on a side thing. So it's 51% over that way. But what I heard out of my right hearing aid was that I can potentially buy my way out of that.
Correct.
So I can buy my way out of that by putting not
Down
3%
payment.
down, a larger down payment.
Correct.
That's what I did with the villas.
Got it.
Yeah, that's
I learned that. I just learned something today. I did not know that.
Yeah, that's what I did with the villas. This question's come in. Can you ask the guest? The guest is Scott Morse, Ross Mortgage. Can you ask the guest the difference between a pre-qualification and pre-approval
Ooh, great
letter?
question.
Fantastic question. So let's say, and here's one that with someone I've been working with for the last couple weeks, trying to get them in a better place, because they had a pre-qualification from something they found online. Said, hey, I can buy for $400,000. In our initial phone call, I asked a few questions that quickly told me that is not what you're going to be pre-approved for. And
What were those questions?
tell me a little bit about your what debts that you currently have. Let's put a number on that, and how much money do you make a month?
Okay.
And
Debt to income.
Debt to income.
Yeah.
Just a quick qualifier, because to get to the the payment at $400,000 versus these other, once you took the debts that she vocalized that she had, once you put the housing payment in there, we were well above 50% very quickly.
So what's a sweet spot?
Sweet spot you'd like to be
0.
It depends on your situation. Let's say that you've got $5,000 a month in
cash
salary
flow
or W-2 income, but you've got a side business that we can't really qualify as mortgage qualified income. So you can go spend as much of the $5,000 as you can qualify for, which is probably about $3,000, going to 55% on an FHA loan. And then you've got this off the table money that you can use to pay your bills with that, we don't, that isn't going to qualify you for mortgage qualified income. But back to the question, pre-qualification versus pre-approval. Pre-qualification, you can go online, you can get a pre-approval without providing any documentation. You can also call bad loan officers who will say, okay, yeah, and they'll send out a letter without asking you for any documents. I'm going to ask you a lot of questions. I'm going to ask you to back it up with some paperwork, because once I've seen it, that is as good to me as a loan commitment. If my team has done their job and we've asked you for everything and we've done all the work, that loan is going to close based on the information that we asked you for. That information is going to be pay stubs, W-2s, bank statements, taxes, depending on your employment situation, and we're going to provide you a high level of service in the beginning so that we don't have problems down the road.
Sizzle reel that. That was damn good. Pre-qualification versus pre-approval. Dude's a walking sizzle reel on this show right here, Scott Morris.
So do you want to, for those out there trying to wonder, how can I win the first-time home buyer? How can I win a bid on that if I'm competing against cash? If I'm a listing agent and Jerry's bringing us a buyer and I have an online pre-approval letter and I see a pre-qual letter from you and knowing her or some other mortgage company that's other than this online thing, our client's going to gravitate to that because we just don't know the validity of that.
Not to mention, if Jerry's your agent, Jerry's going to say, hey, Scott, I'm making an offer with Keith Smith. Can you give him a call and back up this letter? And I'm going to pick up the phone and say, hey, Keith, this is Scott Morris with Ross Mortgage. I just wanted to talk to you about the offer that Jerry Miller's presenting and give you some information as much as I can provide on the buyers and talk about their strengths.
Well said. And you guys have, you and Yona, I don't want to speak for you guys, but you guys have a threshold of who you will do business with based on the documentation they have from day one.
Yeah, we want to we want to set up, just like Scott does, and just like you do in your business. We want to set up expectations and make sure that we have good expectations set up before we go out and look. We just don't want to go out and start throwing darts up against the wall. But what Scott said is super important, because that is a huge difference where we're competing against somebody and I'm representing Jerry and so forth and so on. I'm going to ask the other side to call Scott, and Scott will have a conversation with the other side, and sometimes that makes a difference, right? That personal connection makes a difference on that end of it, and it just kind of adds. So that's a super important thing to get out there.
So I've also helped win many deals
against cash
for veterans, for listing agents who may not have a clear understanding of how the VA product is and how it works. For instance, it is the only product that gives you the ability to go outside of the appraiser in the event of a low appraisal, and it gives you two opportunities to do it. The first is a Tidewater Act, where the appraiser has to say, hey, this is coming in low, can you prevent that from happening?
Sure. And
we go out and get comps that he may not have found or may not have given the appropriate adjustments to, and present him with, here's a document that says this is what you should be looking at and how you should be looking at it. And then on top of that, if he still disagrees, be able to contact the Veterans Administration directly for a reconsideration of value. This happens mostly successfully, in my experience, with high value properties, $1 million or more. So if you go in and you're using your VA benefit to buy zero down on a $1.25 million property, and the appraiser says that it's only worth $1 million, and we can prove and get the reconsideration of value for the other $250,000, we don't need the appraiser for that. We can make it happen, assuming that there are good comps to support our argument.
I had no idea about that. I'm going to give that man props right there. Did you know that?
I'm sitting here learning, brother.
I did not
Sitting
know
here
that
learning.
right there. More questions coming. How did you learn this? What's the mortgage school? Is this the school of hard knocks?
It's a little bit of the school of hard knocks. Also, I've got a friend, you can find him in the mortgage loan originator world. His name's Mike Fisher, who puts on a veterans mortgage advisor course, which is super helpful as well. So Mike, if you're watching, like, big props for that. But a lot of it's just, going through the motions and learning what it's going to take to help people at a super high level.
What are the backgrounds of, is the right term broker?
So,
are you what?
So I'm an originator for a retail bank, which
Okay.
means everything is going through with almost no overlays. And overlays are rules that retail institution puts on top of what the rules are currently written as for the loan program, be it conventional, FHA, USDA, VA, as that stands. Whereas like a Wells Fargo or some banks say, well, we won't lend to credit below 640, or we won't go above 90% loan to value here, versus how Fannie Freddie have set the guidelines in regards to if you can do it as the rules are written by the government.
So it's like zoning, right? Or HOAs, right? We talk about HOA and zonings all the time, whichever's greater, and they can add more rules on top of the federal rules. I want to stay back on the VA end of it because I'm learning here.
And we'll get to your question, Jamie Turner. He's got two really good comments. You go VA. Go VA.
The only just quick thing. Talk a little bit about the certificates. I'm a veteran. I've never used it. I never used my VA loan, which I want to do it.
We can talk all about the certificates. So the first thing that when you tell me that you're a veteran and you want to use your VA benefit, I'm going to ask you to complete application, just as I would in any other aspect. And then I'm going to take your information and I'm going to go to the VA website and I'm going to get your certificate of eligibility. Now, let's say that you're somebody who has been through a bankruptcy or a short sale and you say, I can't use my VA benefit again. Well, you've actually got two different levels of certificate of eligibility. So we could use your secondary eligibility depending on the price point, and you could still be at zero down. So, and a lot of other people are going to tell you that you can't do that, but you can go in and do that if you've been through a short sale. Also, if you've got a house, let's say you've got a primary residence and you want to use your VA benefit again and you want to keep your house, you may run into lenders that are going to tell you you can't do that.
So I can use my VA to refi?
You can use your VA to refi. I'm saying you can have a VA loan right now, and you can keep that. It's called a one-time recertification of eligibility. You can retain that property as your primary residence and then go purchase another property with your VA eligibility.
Dude, this dude is smart. On the fly, in front of cameras, in a microphone, on the fly. This ain't easy.
It's the second cup of coffee that got me there.
I could tell. You took it to a different level.
I'm still telling you with the toddlers
He knows
and the
what that
snow
looks like.
and
I know,
everything else.
You could tell, right?
I can tell. He also knows when I hit my second cup of coffee.
And we should give
Shenandoah Joe.
one of the partners, Dave Favara. Yeah, Shenandoah Joe's.
I'm just learning here. I tell you what, I would love to do on some future show if you guys are up to. Let's do a case study,
That's a great idea.
and we can use my house as a case study.
Okay. Yeah.
Philip Meyer, Robert Lynch, Charles Gunther, hello and welcome to the program. Questions and comments for Scott Morris, put them in the feed, please. Cassie Fitzgerald, hello. This is a good one from Jamie Turner in Gordonsville. He's got two comments. The HOA and condo fees are why I will never move back to Northern Virginia. It makes everything unaffordable. Now, here's the question for Scott Morris. Say a group of friends want to get together and purchase investment properties. They form an LLC and find a multifamily. Would they go through the residential or commercial process for a mortgage on the property?
Are they buying it as a group solely under the LLC? Because if so, then it would be that would be not residential. If
it's LLC, it's commercial financing?
If it's LLC in its as a whole, like there's no individual back, then it would be commercial, not residential.
What if it's okay? And I think you just answered this, but I want to do it for my sake because I'm learning here for me personally. What if it's a single member S Corp LLC?
You'd still, if it's and multifamily and one person, and you're going to reside in one of the units, you would set it up as residential, and you would title in the LLC post-closing.
Understood.
Yeah.
And you count of the rental income 70% of it?
Correct.
Scott,
75.
75%.
So the moment multifamily came out in that question, it kind of moved it, I think, automatically.
What if it was single family detached?
Then that's where Scott just outlined it. Then that kind of makes sense. So what I think Scott is saying is if you want to do that, you should do it as an individual, and then once you close on it, you can move it into an LLC. Once you start buying as an LLC, it's difficult because it's a business purchase, not a personal purchase. And it was funny. I wrote down on one of my notes is when do you think some of these lending, I don't want to use the word restrictions, but I can't think of
Are
another.
you going down no doc loans?
Well, I wasn't going to go that far into it, but maybe that is where I was going to end up. But I was really going to ask the question, are you going to see some easing of lending requirements?
And does that terrify the hell out of you?
Well, I don't know. It depends on that's such a high level political shell game. Does the new person that I can't think of the name of coming into housing that Elizabeth Warren is supporting, is that who's influencing the rules? Then you're probably not seeing an easing of anything, or at least, but if you're seeing, that really has more to do with who's playing that shell game of who's going to influence the rules more so than anything I think that the market does.
So I'm conflicted on the answer to that, right? On one hand,
my answer is I don't know.
On one hand, our case study that we'll do, that would be super helpful for me because of our personal situation and that we are.
But this goes into if you were having a baby with your family, would you not buy a house because interest rates went to 5% and stay in an apartment? Are you waiting to make a decision based on future rules? Like that's not something I think any of us.
When we do our case study, I'm at 6%. So
Daniel Harper, hello. Daniel Harper's in the insurance business, giving you some props right now. You got some props, some questions, some praise, anything for Scott Morse, Daniel Harper, put it on the feed, we'll relay it on air. You got a lot of people in your spaces or supporting spaces watching you. On the show.
Hello, everyone. Thank you. I'm glad you're snowed in and have nothing else to do.
That's for Scott Morris, Ross Mortgage. That's right. You've learned, Keith. You've learned. Bill McChenzie, hello, and welcome to the program. We love when you watch the show, Bill.
I tell you what, he's a good human.
How about this one? From Kelsey, who routinely watches our content. We love you, Kelsey. Can you put in perspective the various kinds of financing you can get once you've already owned a home?
Great question.
So I think she's probably alluding, and Kelsey, offer more perspective.
Are you looking to
HELOCs?
Are you looking to get additional value out of that home or purchase another home? So if you're looking,
or lower your payment.
Well, so that would be. So an additional type of financing. So that would be refinance the current property. You could do a home equity line of credit.
That's the HELOC.
To get the equity in the property out to use as cash to do a lot of the same types of tools that you would for a cash out refinance, and that would depend on how much money you need, how much equity you have. The greater the equity and the more money you want, it would be a bit more beneficial to do a cash-out refinance than a home equity line of credit. If you needed a little bit of money and you had a little bit of equity, the home equity line, the HELOC, is probably your product. If you were to retain the property and purchase another home, is it going to be a home that you're going to turn the current home into a rental? We would do a primary residence conversion where you would put a lease in place for the current property and then buy the next property based on the tenant who's going to take over that property and wash that mortgage. If you're going to keep that property and buy a second home further than 100 miles away, or maybe even if we could sell it in a Wintergreen, Massanutten type of area, you would put 10% down in a second home purchase, and I think that covers a lot of
That
it.
did. That did.
Can you
Questions
slow
on
down and
vacation
try-
homes coming in. Go ahead. Go ahead.
I'm not-
I know, dude. I know. The guys in Fuego, the Shenandoah
like-
Joe's is kicking in right now.
I was like, okay, I had one simple case study, and I was
he's
like,
on
hold
fire.
it,
He's
let's do
killing it.
another case study.
Dude is good
on
in this setting right here.
on this stuff.
DP, we will get to yours. Neil Williamson, Sir Neil Williamson, welcome to the program. A lot coming in right now. So how about this one? What is the lowest credit score you will accept with Ross Mortgage, or does it depend on each client? What is the lowest credit score you've ever seen
That's a better-
get a mortgage?
580.
580?
580.
At what interest rate? It was a
How
little
many
higher.
points above market?
It's probably they probably had to buy into 2.5, which is about as much as you're gonna. So one of the things that you have to worry about with lower credit is something called failing points and fees, meaning that there's certain parameters set around how many points and the total amount of money and percentage that the borrower can be charged. So
Try that again.
So let's say with all these LLPAs, so loan level price adjustments, let's say you were buying a double wide and you had 580 credit. The lender most likely would have to make some sort of concession to pricing to make it work, meaning I would have to give money to your deal in order for it to not fail points and fees, because there would be no par rate. You would be paying points just to get in the door. But that amount of points and fees could exceed what is allowable, even as a...
I don't follow this one here.
So
I got it.
when you get into high-priced mortgage products, meaning the paying a lot of points just to qualify, there's rules around what you can actually charge a borrower.
Okay.
The lower the credit and the type of product could affect their ability to actually execute the transaction. Meaning the fees could be so high, they may not be allowable by mortgage lending rules.
Okay.
So go back to why I was asking, are we going to start lightening up some of these rules?
That's part of what got us in a position that failed
agreed.
to begin with.
Agreed.
So
Agreed.
as long as there's such a high pool of borrowers, let's say this, if we got into where the rates were so high that it affected the housing market in such a way that people weren't buying houses or couldn't qualify to buy houses, you'd probably see a rollback in some of the rules. But right now, there's such a high pool of borrowers, buyers, that why would the government roll back why would they allow more risk if it didn't impact the economy?
So what they're saying is under certain loan programs, there's only so much of points you can buy down, or any type of the seller, right? The seller can contribute certain percentage. There's a certain amount of percentage of the total loan.
Correct. So 4% is like the FHA guideline, and then 3%, or 6% FHA, 4%, or 3% conventional, as far as seller concessions. Seller concessions meaning, let's say that people talk about, we want to roll in the closing cost.
Great.
Okay. So if you want to roll in the closing costs, they don't have value, so they can't be applied to the loan. So the way that would actually work is, let's say we all agreed that the sellers would be happy taking $300,000 for the home, but you needed $9,000 in closing costs. Well, we would then, assuming that the property would appraise, shift the purchase price to $309,000, and the sellers would give you back that $9,000 at closing.
Dude, so you want to know how well you are doing? You have fellow officers in your space, competitors, giving you props right now. Roger West of Roger West Shamrock Home Loans is literally putting on the feed, this is fantastic knowledge right now from Scott.
Thank you, Roger West.
Do you know Roger?
I have no idea who Roger West
Okay,
is.
Roger West is giving you props
But you should
and
know
watching
who Roger West is.
Okay, giving you props right now on the feed. Smith.
Yeah, so that's exactly right. And then this is where you need a trusted advisor on the real estate side, and the loan side is to say, because one of the questions we're going to look at is, hold it, do we think it's going to appraise for 5 or 309?
Here's even a better example. Let's say that we knew things were going to be super tight, and you were a competitive agent with a big heart and said, look, man, I'll give 1% of my commission to this guy's closing cost if you'll give something. And I said, yeah, I'll give 1%. Let's go get this done. And we didn't talk about.
So this is an important thing you just said because we're going to constantly, I'm going to constantly go
Reference
back
the phone.
to the apps.
And the phone's not going to do that.
The phone is not going to give you
Yeah.
1% or give you cash to help you get across the line.
How often does that happen?
Quite often.
It does?
And let's say the agent, let's say we had that conversation in private and said, look, we will figure out a way. Well, let's say we get this 300,000 house appraises at 315. And then we went to the other side and to the buyer and said, hey, look, you knew that you were going to be close on these monies, and you know that you don't have enough.
So it's all
Are
about.
you okay if we increase this to make this work
Sure.
for everybody? And we'd come up with a solution.
Jerry, it's all about relationships. It's all about putting the person in a home. And if it's a matter of hundreds of dollars or $1,000 or something like that, we'll figure out a way to make it happen so this person and this family can move into their home. I mean, that's ultimately the goal for Scott, the goal for Keith and Yona, the goal for all the folks that are living there. It's really not about the dollar. It's about putting people in homes, right?
Yeah.
And keeping them in homes and helping them stay to get the American dream, whatever you want to call it. But that's an important thing that
Yeah,
you said.
you have someone who's like, when we talk about a team, do you have people that you can trust to take you through the process, or take your customers through the process?
So let's talk about buying down points.
Dude, that question literally just came in the feed. Points are extreme, aren't they?
Correct. So you can buy you.
Sure. I got a quick and easy answer for this one. So we're going to take.
I'll drink coffee. It's okay.
He's good at this, dude. He's good at this.
Let's take the amount of money that you're going to spend, divide it by the monthly amount that you're going to save, and tell you how many months it's going to take to recoup those
There you
funds. Once we reach a point that if this is not your forever home, if you're not going to make this money back in the first 5 to 7 years,
Then it doesn't make sense.
is it worth it for you to do it? Or do you just have a lot of money and you're like, no, I want to be able to tell people that I got the lowest rate possible? If that's the case, I'm not going to stop you from doing it, because I get no benefit, but you get no benefit either. So
That's a thing, by the way.
Is that ego?
That's a thing.
some people, I don't know. There's a comfort level. If as far as like I want to go, I've got this money to spend, or this money's being gifted to me.
There you go.
And I have it to spend. What can we do with it? It's
Or they just have, I want this rate. I want
Yeah.
this rate, and this is the rate.
You see that?
Not that often, but
if I see it, I do everything I can to educate you out of it.
Well, and that's a great thing that
Yeah.
you just said. At the end of the day, what we're doing here and what we do every day is just an education. We're educating folks all along. But the reason why I wanted to bring down the buying down, you can buy interest rates down, not buying points down, but you can buy interest rates down, or we're having the same conversation.
So it's the same thing, but so it goes back to a high credit individual is going to be paying points to buy the rate down.
Got it.
A low credit individual may be paying points just to get in the game. So there may be no par on a rate sheet. So if you're being told, what do you mean I've got to bring at $300,000 $6,000 just to be at whatever that rate is going to be? It's because you are not in a credit position where an investor gives you a par rate, meaning there is no cost to lock in that rate.
So how many conversations do you have? You're sitting down with Keith and Yona, and you said, look, we need to help you with your credit score a little bit, right? You have those conversations, and you help folks. Let's figure out what we can do to help get your credit score.
Okay, let's go even a step further back. What are the credit score? What is a good range? And that's such a open-ended question for you here. What is considered upper tier, top tier range?
In my opinion,
Second lower tier, third lower tier. You've already said 580 is the lowest you've ever seen.
But 850 is your high.
yeah, well, not lowest I've ever seen. Lowest I've ever seen approved for a loan.
That's what I meant. Yeah.
So,
What's like 650 to 700?
all right. So let's break it down
Yeah.
into 580 to 640, 640 to 680, 680 to 720, 740. That can be kind of gray. Your 740 and above, there's very little benefit to rate to you at that
Yeah.
point. If you're my credit is 810 guy, and that's very important, it's like, that's cool, but if you were like 745, you're not, there's like very
The delta.
low margin of difference. Like, that's great for you, but it stopped being great about 60 points ago.
Okay. What are most people?
Most people?
Most applications you're seeing, I guess, is a better question.
I think your average is probably upper to mid sixes, as far as like I think that's probably just like when you get to what is the average income in America, because you're going to see a bunch of 800s and you're going to see a bunch of 400s. Somewhere in the middle is about where everyone is. Where you should be as far as ideal numbers, if you can get there, 700 is a good place to be.
Yeah.
The first thing I'm going to do based on that initial conversation, if you're 580, is say, what could we do to get you
A little
above
bit.
640?
So probably if you're 580 and you get some credit card debt, and you're the experts, I'm just asking here, I'm trying to use some common sense. If you're 580 and you got some credit card debt, your probably first step before buying a house is to get off that credit card debt.
Depends on your situation. Like, if you're in a situation where you were a 500 and you've just spent the last year busting your ass to get above 580, and you're like, I'm in a situation where I have to this has to happen for me. Like, I don't have another day, I don't have another week. Like, I've got to pull the trigger now.
Got it.
We're gonna go get it done.
Yeah.
Now, if we got another 60 days, and I can say, hey, look, this would be better for you if I could get you here, if you could do these 3 things. I'm going to send you the 3 things, and we're going to have a conversation about what that looks like.
And how quickly does that take effect? So in other words, if you give me those 3 things,
Let's say
the reason I'm bringing this up, Scott,
There's several different paths. One of the paths might be we wait. At that point, we may have to wait 30 days because it's not always the money that affects your score.
Yeah.
Sometimes it's also time.
Yeah.
So I may say, hey, look, you can do these 3 things. One of these 3 things is opening a new account. We need that to report, and then we're gonna pull a new score. Or it could be, pay these 3 things off, send me documentation from the creditors. I will then send them to my credit company, have my credit company update each individual bureau, and have you rescored in the next 2 weeks.
You know the challenge I had, and you probably have encountered this. This was fresh out of a couple years out of UVA, okay? Busting my ass, working, saving
borrow
some
any
money.
money.
Never had a credit card.
Yep.
I had no credit.
Yep.
I had the money down,
Yep.
sizable chunk, not
Yep.
sizable, but for a mid-20s down, but no credit, didn't have any credit cards.
So
Yep.
here's the quick solution for that is I'm going to ask you if you have a family or member or friend that you trust that has good credit and a long-standing card, and I'm going to go ask you to be put on as an authorized user, and you're going to report a score almost immediately.
Yep.
Damn, we did not do that. I did not
Because
do
you didn't know him.
I didn't know Scott Morris. No.
So the reason why I wanted to have this
So I
credit
put
score,
20% down.
the reason I wanted to have this credit score conversation is for a couple of reasons. If you are at 580, a little bit less, don't give up, right? Pick up the phone, call Scott, right? If you and he'll do these 3 things or 4 things or 6 things or whatever it is. You have that conversation with Scott, and it could jump you up at least a little bit. It looks a little bit better. I learned something today. I did not know there was a huge difference, not a huge difference between a 740, 750, and an 850. And then one last question to ask you, because I want to check my credit score. What's the best way to do that?
Well, and to add to that, there is the stigma or misconception that constantly checking your score dings your credit. So both topics for you there, Scott.
I'll add one to it. So if you were looking, so there's 2 types of scores. There is a Vantage model, which is what you most often see reported through your automated credit card.
Right.
Hey, here's your score, your Credit Karma, and then there's a FICO score. Of the 3 credit bureaus, Experian is the only one that gives you a true, honest view of what your FICO is, and even then you've got to sign up for their whatever the dollars a month it is, to go in and view. Then you go to FICO 8, and you can actually see what a mortgage model would be.
So the FICO score I get with my Bank of America is not a legitimate score?
I
mean,
literally was going to ask that
it's-
question. I was going to say
Because I check it all the time.
I was going to say Discovery
legitimate.
card.
Okay.
But how it's actually scored in a mortgage model is probably, depending on your credit balance, different than what I would see when I pull by.
Is it usually higher or lower?
Probably, you're probably seeing higher than what I'm going to see.
Yeah.
Wow.
But it depends on your credit situation. Sometimes it can be very accurate, but if you've got things that have recently been paid off, so to where that you see that jump there, the mortgage model could be behind that depending on what your total debts are. But the best way to check it, in my opinion, there is a website, I think it's called myfico.com, that generally reports pretty accurately
Everybody watching is writing that down, including
to what I'm seeing. Because
I got it. I'm good.
And then the third additional part of the question, we'll jump more. But talk about when checking your score frequently can affect it. As long as you're checking it through these sites, there's going to be no impact. Let's talk about when people pull your credit, how that affects things.
like to purchase a car.
To purchase a car.
Okay.
If you go in to purchase a car and they're going to give you our 0% interest for
5 years.
20,000 years.
Yeah.
And then they go, oh man, you don't qualify for that. But we sent you off to a couple of our banks and we're going to get you the best deal possible. Well, that's probably 4 banks. 4 to 5 in total. They probably got 3 that they work with, and then whoever their main is, and then maybe depending on if your credit is less than if you're sub, probably sub 660 or so, they're probably sending it to a 5th place as well. So that's 5 inquiries. Each of those inquiries is worth about 3 points.
Damn.
So you could have a 15-point impact based on that 4 to 5 inquiry pull at a car dealership. I am going to pull your credit once for 3 points. So assuming that you were someone who regularly pays your bills, in 30 days it's going to be like it didn't happen. My mortgage inquiry isn't going to adversely affect your credit. It's a huge thing that people have as far as, I don't want you to do this because it's going to hurt my score. I'm going to pull once. It's not going anywhere else. It's not going to impact your score greater than 3 points.
And since I don't know what I'm at, but let's say I'm at 750, just to pick a number, and you pull it, I'm still good because I'm not under 740, right? Because I've just learned
The
740
threshold.
and 850 is pretty much the same, right? So,
Dude, this show has been fantastic. This is the first edition with Scott Morris. Wednesdays at 10:15, guys. Wednesdays at 10:15 with Scott Morris of Ross Mortgage. Keith, this question's come in. What is the lowest interest rate you have ever given?
remember we're buddies.
It would have been last year during like the refi boom on a 15-year or a 10-year at like 1.875 or something crazy. And they bought down to that because I think par was probably 2.25, which is
1.875. Jesus.
yeah. They paid points. To
But it was a 10-year, you
I
said.
think it was a 10-year.
10-year on a home purchase?
Not on a refinance.
Okay, on a refinance. Good God, that is cheap money.
Those rates are gone.
Yeah. Those rates
They don't even show up on a price sheet at this point.
Let's set
Stipulate
expectations.
that, I know.
Let's set
That's what he's doing
expectations,
right there.
gentlemen.
Smart man right there. More questions coming in here. How about the
I'm out of paper,
consultation?
man.
This is it's a great show. Consultation that you give for a family that wants to purchase a home that's contemplating a 30 versus a 15. A 30-year mortgage versus a 15-year mortgage.
Well, the first thing is going to be what do you qualify for?
Okay.
And then your comfort level with payment. So if you're high earners and 15-year is double the payment of what the 30-year would be, or almost double, and you're like, this is where I want to be. I want to put down as little money as possible. I want to reduce. I want to come as little cash out of pocket in doing this, but I'm not scared of how big the payment is.
Yeah.
Then that would probably be
My
the path.
cash flow is good with
So
that.
that's like that's almost borderline a doctor loan.
Yeah, that's close. Which is really just a doctor loan mostly is not taking into account student loans.
Yeah. And considering earning potential.
Yeah.
So Jerry and I debate this subject all the time, the 15 versus
The ERPs.
30.
Remember we had this?
We had this whole...
I'm a 15 guy.
Yeah, and I'm a 30 guy and pay it down extra couple months a year or 2 to 3 months a year, and it gets you there, and it gives me the flexibility. Jerry's argument is most folks are not religious enough to do that.
I'm just basing that on myself.
Yeah.
And I'm also basing it on myself with the 15, knowing the 15, it puts your back against the wall proverbially and motivates you.
And the important part of the conversation we're having here,
So set the payment up automatically with.
If you're saying go 30 and overpay with an auto pay.
With an auto pay, so you're not actually.
that's what we do.
You're not forced to look at and make the decision.
And then you have the
Gosh,
buffer
come
in
on.
case shit hits, in case the hits the
Yeah,
fan.
yeah.
And that's what we do. And by the way, in full clarity, is Mrs. Smith still watching?
Yona is watching.
Yeah, she handles all this anyway. So.
we know, Keith.
Yeah, I have a debit card.
That's his beautiful wife for those that are new to the show.
Yeah, my debit card has a certain fixed cash amount on it. Otherwise, I'd have a new bike.
How many
Maybe two.
How many get 15s in your business?
You don't see
On
it.
a purchase,
Yeah.
very few.
Yeah.
Yeah?
Yeah.
What is the advantage of the 15?
The lower rate and the lower term. But when people are faced with the payment, making that decision,
It's terrifying.
Yeah, it's
If your cash flow supports it, right, and you can do that, and you're on a 15 and you make a couple extra payments a year, that drops that
Significantly.
significantly
let's talk,
down.
I mean, we tiptoed on the auto industry with credit pulls. They've gone to 80-month auto loans now on
81 months.
Yeah,
It's insane.
Think about that. That's
On a car-
on a car that
Depreciates.
is warranted for 3 of those years.
Yeah.
Dude, so I got the Ford Explorer
Mm-hmm.
during 2020 COVID when the dealerships couldn't give the cars away, and they had no interest loans for 7 years. Now, the no interest is different because there's no interest on there, but still, 7 years of no interest. This one has come in. How many people ask about reverse mortgages?
Ooh, great question.
So reverse mortgages, I don't do a lot with.
Explain what that is.
So that is where you've got a couple different options. You can go in and take a one lump sum payment, and then you pay back that mortgage over the course of time. They can also
People don't realize you have to pay that back.
yeah.
And to include my parents, we had this discussion over the weekend.
Well,
Go
because you
ahead,
know
I'm
what
sorry.
they did? They probably saw one of those reverse mortgages commercials
Well, no.
on late night TV and said, "Oh, this works for me,"
Which
is-
because they target seniors.
Yeah, and the
100%.
reason
Well,
it
just
works-
because you don't qualify unless you're
Exactly.
50, 60, 55. I don't know. I don't know enough of them to where I'm going to get into
Yeah.
the rules.
Can I? Do,
The
do I
reason
say,
it works is people are outliving their cash.
That's what it is.
Yeah.
That's what it is. Is the reverse mortgage? How would you characterize the reverse
It
mortgage?
just doesn't feel right. But
Is that-
I'm sure
is that-
it works for people. But a lot of folks don't know. And I'm learning about this because my father.
You chose your words carefully right there.
Would I do them if, as far as it not feeling right? I don't know. I think for some people.
But doesn't that put an undue burden on the heirs?
No.
Oh, really? I did not know that.
What happens to the mortgage when they die?
Yeah.
The servicer.
Eats it.
No, they take the house.
Yeah.
The house.
Well, that does impact the heirs.
That does impact the heirs.
That's a family problem. That's not a mortgage problem.
It's not a mortgage problem, but it is. So if my mother and father want
To gift you the
the equity from the house,
So what if they took a cash out like years
is
before?
is Michael Fisher the gentleman you were referencing?
Yes.
He is watching right now. Veteran lending counsel at Ross Mortgage and Hancock Mortgage Partners.
Yes.
Watching right now. You want to say something to Michael Fisher?
Big shout out, Mike. We were talking about some VA stuff earlier. I don't know if you caught it, but love your program. If there's loan officers watching, they should sign up, get educated,
And is
help
he a
your
Marine?
clients at a super high level. No.
oh boy.
Philip Meyer, I got to run. The show's been fantastic. For everyone out there, Scott Morris is your man. He helped my family. It can help yours. I highly recommend Scott Morris. I cannot say enough great things about this man.
This is show 251, and 250 of them I throw away my notes after each show.
Dude.
Thanks
This
a lot.
one I am not going to throw away.
This is the like high level college course on mortgages from the man right here, Scott Morris.
It's funny you should say that. One of the thoughts I've been thinking about doing a series of shows called master classes. And
That's a good idea.
Which is,
Are you gonna? I think somebody may have trademarked that.
really?
I think he's
He'll
right
keep
on
me
that.
out of trouble.
I think that he's right about that. I try to keep you out of trouble,
Yeah.
but we've gotten so far through that.
Yeah,
Philip,
well-
thank you for watching.
Mrs. Smith and you will keep me out of trouble.
Dude, you know when the show is good when the first time you look at the clock and you realize it's 11:40.
Oh, wow.
11:40. It has flown by with Scott Morris. What are your thoughts? Anything you want to close with? We got to get Scott some closing as well.
Yeah, we'll let. I mean, this is all about Scott. We'll let him wrap up. I'm serious. And he knows this. I normally throw my notes away after each show. I'm going to keep this on there because we're going to do some case studies.
Okay.
We won't call them master classes. We'll call them case studies.
Scott Morris, closing thoughts right there. And people, give this man props. Michael Fisher is loving what he's seeing right now. Michael Fisher, we thank you for watching this program, sir. Anything you want to close with?
If you're here in the Central Virginia area, I hope that you get power, service, heat.
Oh, yeah.
If you're in an area where you are without Fluvanna, for instance, and you need to get to the warming center, or you need someone that needs some help, don't hesitate to reach out to me on Facebook. I've got a ton of community members that would love to help and serve you, if at all possible.
Look at a quality guy, right? He had
Yeah.
an opportunity to talk about himself, and he talked about others. Well done, sir.
Yeah, dude is A+. Smith, anything you want to close with?
I think I just did.
Yeah.
I think I just did.
Gentlemen, I sincerely mean this. This show exceeded my expectations for episode 1. Exceeded the expectations.
we need to ask him what his expectations.
Well, I mean, I didn't know what to think. We were coming in during a snowpocalypse. Scott's first, he's done the show many times
was his
here.
expectations an 850 credit score?
I wasn't sure, but what did he say? The average is somewhere about 650.
Yeah,
Somewhere about
650, so that's where he was
I'd
at,
say this is
650.
about 780, 790 right
and you
here.
know a guy.
Yeah, and you know a guy. You know a guy. People, rewatch this show. Contact Scott Morris of Ross Mortgage. Judah Wickhauer is the man behind the scenes. Judah, hell of a job by you, per usual.
Amen.
Keith Smith of Yes Realty Partners. Scott Morris of Ross Mortgage. My name is Jerry Miller. This is every Wednesday at 10:15 a.m.
Keep an eye on the bottom of the thing for the folks that are in our chain, so please support them.
Well said. Well said. Thank you very much for joining us, guys. I Love Seville show is up in about 44 minutes right now. You guys have a good morning. Take care.